Another man's trash is another man's treasure is an adage that we've all heard growing up. But can trash really turn into treasure? One company has been proving that this is possible for decades, and their name easily reflects this: waste management. Their name is literally a term used in their industry, or if you are a golf fan, you might have seen their logo as they sponsor the WM Phoenix Open. Being one of the oldest companies in their field, they have been the invisible hand that has been moving and improving the waste industry in North America. So, how do they do this, and are they a good investment at these prices? Let's find out. To have a better understanding of the company, we must first understand the waste stream. The waste stream is basically the entire life cycle of waste. From a customer's trash bin to the landfill, multiple steps have to be taken to ensure that the waste is properly taken care of. This can generally be broken down into five segments: collection, transportation, recycling, selling, and disposal. And guess what? Waste management participates in all these areas and is essentially the largest contributor to North America's waste stream. They have extensive advantages in the industry, but I would say that their deepest advantages are expertise and asset network. Their expertise started to develop more than a century ago by Harm Huizenga, a Dutch immigrant that innovated in their industry in 1893. More than 6 decades later, in 1968, Waste Management Company was started by Wayne Huizenga, the grandson of Harm, and two other investors, Dean Buntrock and Larry Beck. They focused on creating a company that could properly manage waste, hence their name, Waste Management, as the North American population grew larger throughout the years. By 1982, they were the largest waste disposal company and IPO'd just 6 years later. This means that they have been industry experts for more than a century before their nearest publicly traded competitor, Clean Harbor Inc., appeared in 1980. I can't even express how insane it sounds to have a lead that huge. To add to this insanity, their asset network consists of, let me take a breath first, 262 owned or operated landfills, 506 transfer stations, 105 recycling facilities, 69 autoclave facilities, 18 medical waste incinerator facilities, and 107 secure information destruction processing facilities. The whopping amount of facilities they have as of their 2024 data reflects how they've built their advantage for years and the additional assets gained from their acquisition of Stericycle. This deepens their moat as customers can essentially use their services to complete the waste stream value chain from end to end. Also, as owner and operator of these facilities, they benefit from this vertical integration by attaining better cost efficiency, which results in higher operating margins. As this industry is essentially a need in society and would require commoditized pricing to compete at scale, I would say that this vertical integration is the key to creating additional value. With their expertise and solid asset network, I can easily say that they are one of the two highest quality companies that continue to move and improve their industry. Now that we understand how they turn trash into treasure, let's see how they fare against publicly traded competitors. Aside from my usual metrics, I will be adding net income margin and airspace cubic yards to see how efficient they are versus peers. Airspace cubic yards, by the way, represents the available landfill space they have. As you can see, Waste Management and Republic Services Inc., or RSG, have the largest amount of landfill airspace versus competitors. These two companies account for more than 20% of the landfill operation and ownership in North America. Though RSG does not disclose the exact amount of landfills they own, WM owns 221 of their 262 operated landfills. That is a whopping 84% of their total landfill operations and about 8.4% of total landfills in North America. This adds to their deep moat as the barriers to enter are high in landfill ownership. You need lots of cash, expert engineers, licenses, and much more to own one. Aside from this, their operating and net income margins are practically the same, showing that the business model can be replicated if done correctly. What separates WM from RSG is their return on equity of almost double the efficiency. This led me to think, why is WM way more efficient? Does it actually make them better? To answer the first part of the question, I dove into their financial statement, saw their efficient use of debt. So why do I say that their use of debt is efficient when I usually stay away from companies with high leverage? My answer to this is their operating margins. The operating margins computed here include the interest expenses that each company incurred. As you can see, despite WM borrowing more money, they are still the most efficient among peers. Now, for the second portion, does this make them better? I would say that this is dependent on how top management handles their debt. As of making this video, I would say that they do handle it well as they continue to return to targeted leverage levels by mid 2026. Even if they did not specify what their targeted leverage level is, it can be assumed that this is related to the restrictive financial covenant of their $3.5 billion revolving credit facility. This revolving credit facility requires them to have a leverage ratio of 3.75 times or lower and have the option to increase it to 4.25 times or lower if needed. After having a look into their 2024 annual and 2025 quarterly reports, it shows that they have been operating within this covenant. Their trailing 12-month leverage ratio is within 3.75 times, while they've increased their interest payments by 75%. Put that into perspective, they only increased their total debt by around 48% for the acquisition. This shows that top management is acting on their mid 2026 leverage ratio goal. Additionally, they have suspended their share repurchase program, which is another plus in my book. This is a plus in my books as it shows that top management made the decision that acquiring Stericycle was the best way to return shareholder value during that time frame. This discussion shows that they have an amazing understanding of investing, especially when looking at their valuation at current prices. With their amazing business model and disciplined top management, I can say that WM is the best company that can turn trash into treasure. Now, regarding their valuation, I am not convinced that it is time to buy the company, similar to top management. Even if I see them as the highest quality stock in their industry, their price makes them uninvestable for me when compared to other potential investments. My investment decision relies on whether or not this is the best company that I can pour my money into. As there are other high quality companies with better valuations in my watch list, it deters me from investing in the company at current prices. This does not mean that I think the company cannot sustain its moat, but part of my investment criteria is investing in companies with a solid margin of safety. As I currently see them as overvalued, this means that they have zero margin of safety from my valuation, hence my decision to not invest in the company at these prices. As for my steps moving forward, I will continue to monitor the company and hope that its price lets me turn it into treasure. With that, I would like to end this video with Warren Buffett's famous line on investing in companies. Price is what you pay, and value is what you get. For the investor, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business development. Thank you so much for listening to my analysis. For those who are curious about my portfolio updates and changes, please don't forget to like, comment, and subscribe. I will be doing this for future videos as well. Thank you so much.